Charles Taerk joins us now. He's the president of Fairpoint Asset Management and the portfolio advisor to the 9-Point Alternative Health Fund. Chuck, welcome back.
Thank you very much. Hope everyone had a great summer.
We had a great summer. Me and Jeff Zanzanuri are in the process of looking for the next big cannabis deal, and you have an extreme wealth of expertise and experience in investing in early stage cannabis deals.
Sure.
How important is it in the strategy of the UIT Alternative Health Fund to invest in private placements before the companies actually go public?
It's very, very important. From the very beginning, so as a mutual fund, we can own or invest up to 10% of the fund's capital in private equity. And so what we've done is we have chosen companies that are, 3 to 6 months away from an RTO, as well as some companies that are a little bit longer, but we see great promise in their business. Not really Canadian companies, looking at American businesses, and looking at European companies, looking at one Israeli company that we've invested in. It's really important because the valuation metrics that you're able to get early on are much lower than the public sector multiples. Plus, you're getting benefits, whether there are warrants attached, whether it's a convertible deb that's got preferential treatment on the exercise price. Plus, you're able to help shape the future of this company. And that's really exciting.
Mm-hmm. Okay, so give me an example. We just had Bruce Linton on set.
Yeah, it's nice to run into Bruce.
You bet. And so he's got his ideas about the importance of being early and how he's going to provide access to us to his early stage endeavors in the next chapter of his professional life.
Okay.
Tell me about the access that you've had in the past, and specifically with your experience with Canopy, in which you were somewhat early.
Sure. Well, okay, so Canopy's a unique story, given Bruce was just here. Canopy has been or was in our fund in a significant way for over 2 years. The fund is 2.5 years old, so probably going back to May or June of 2017, and it's been a top 10 holding of ours since then. With the unceremonious departure of Mr. Linton, we took the view that Canopy now is a very different company. We don't know who's going to be running it next. We don't know what the new leadership at Constellation wants for Canopy. And so we took the approach that until there's clarity, we're going to take the opportunity and exit. So at the end of July was the first month where Canopy Growth was no longer in our top 10. So we sold it down in a big way, also anticipating that the next quarter, which came out middle of the summer, was pretty horrible.
Right.
And now the stock has trended down. So we're being cautious on the name for now. But so maybe a testament to Bruce that we liked it then. Now we're on the sidelines. But absolutely correct. When you own a stock at $1 or 50 cents, and it rides up to $20 or $30, that's one to write home about. And so you don't care if it was at 50, came back to 20, you're still sitting with such a low adjusted cost base.
You're free rolling.
You're still, that's right.
I mean, it's been a challenging summer, Charles, but
yes.
If you take the longer view, which we all should as investors,
Mm-hmm.
this is an opportunity, yeah?
Oh, absolutely. We've done a couple things. When we meet with advisors and clients, they're obviously shaken because the last 3 or 4 months have not been kind to the sector.
Right.
But if you take the longer term view, we're still up on the year. We're still up since inception, and we believe that we're at a really interesting inflection point given what we've done with the portfolio. So obviously we're active managers, and we exit positions when we don't feel things are going well. Like in the spring, we sold our position in CanTrust in April, got out around $9 or $10 because at the time their quarter was weak. We didn't like the margins and the revenue prospects, and so we exited long before July 8th. So being active allows us to take the capital and do other things with it. we've really reoriented the portfolio more towards the U.S. multi-state operators than to the Canadian names, and we started really doing that at the beginning of this year. And the payoff we think is going to begin shortly now that we've gone through the summer. The last 2 weeks, the U.S. MSOs have all delivered really strong quarterlies. So top line revenue growth, significant revenue growth quarter over quarter, let alone year over year. It's just been phenomenal. But more important and very different from most of the Canadians is they've got cash flow. They've got bottom line positive EBITDA. And for many of the Canadian companies, they're having trouble generating. And I think that's part of the problem with an investor's viewpoint of this sector is when do these companies become profitable? So that's why we've moved to orienting to the U.S. names like a Curaleaf, Cresco, GTI. Those names are really doing quite well.
And how has the fund done in this environment over the last few months?
Yeah, so this is still a focused cannabis fund. So remember that when you look at it that way, year to date, we're up 7.6%. And when you compare that to the HMMJ's up 1.3%. So significant outperformance for the year to date marker, and more pronounced when we look at a 1 year number to the end of August. We're flat for 1 year, but HMMJ is down 30%. And so when people most often compare us, because HMMJ is a large ETF, what's the value in the ETF? I would suggest people really take a look at it because this is a passive fund. They're going to take on positions every quarter, regardless of where they're trading, whereas we have the benefit of being active. And so some great examples, both being early and exiting early, would be looking at Tilray. Tilray went public a year ago at $17, and we were in the IPO, and over a 5-week period, it went up to $92. At that point, we sold it. It was our biggest return for 2018. But HMMJ didn't take it on until the third week of September last year at $140. Tilray is now trading in the high 20s.
As an active manager, you can be a bit more discerning on subsectors. Are there any you're particularly hot on, or any also
like within cannabis or just
within
outside?
Cannabis? Yeah, within cannabis.
Well, as I said, we certainly like the U.S. names, and within Canada, we like the extractors here. The Medifarm, Valens are both showing the benefits of what the services provide. And each of them, as Cannabis 2.0 gets rolled out, are both going to have great opportunities, sign more contracts, get more distribution, whether it's private labeling or tolling. The growth that they're going to achieve without having to put capital in the ground on the agricultural side is going to be representing higher return on invested capital. So that's why we like the extractors necessarily more than just owning the LPs.
Mm-hmm. In terms of early stage pre-public cannabis opportunities, where do you see the greatest opportunity for investors in what sort of segment?
Well, again, focused more so on the global market and the U.S. market, because we have to remember as Canadians, we're only 37 million people. So you want to find companies that are taking advantage of large addressable markets. So in the U.S., even though there's 33 medical states, it represents close to 200 million people. That's a larger addressable market than Canada. So we're looking increasingly at new products that aren't available in Canada. So whether it's beverages with CBD, the Farm Bill has really changed the dynamic for the cannabis industry in the U.S. CBD products are available in thousands of locations outside the dispensary networks. There's branding, there's marketing, and so we've invested in a beverage company. It's called Hemp Hydrate. Very simple, and we think it actually gets around some of the the lack of clarity that the FDA has presented, that It doesn't claim CBD. It doesn't claim to do anything, doesn't cure ailments. It's very simple. It's actually a really cool bottle, and they're getting great traction out in California with intense or high-performance trainers because it's a recovery drink. Actually, Sylvester Stallone, when he was filming Rambo 4, had a box of hemp hydrate. I think they filmed it in Bulgaria. And from his trailer, he did some promo on Instagram about hemp hydrate. So it's just a simple bottle, and but it shows you the opportunity for what's coming in the U.S.
And is that a publicly traded entity?
No, it's a private company. They've raised capital a couple of times in the last year, and we are helping them with, possibly down the road, listing both in Canada and the U.S.
Great. So you'll be sure to let us know when there's an early stage investment opportunity.
Absolutely. When they're looking for more, we'll tell you.
All right, Charles, let's leave it there for now. We'll come back to you soon. Thanks for joining me today.
Okay. Thanks very much for having me.
Only one, two, three.